Hello, welcome to the IRA Club series on self-directed IRAs. This video is part of the Basics series, and in this video we're going to talk about something very important and of interest to just about everyone who uses a self-directed IRA, and that is the topics of the tax status and the topic of asset protection inside a self-directed IRA. Both of these are very powerful, and they both really are quite simple to understand. Let's begin. Now, there are two important advantages when investing inside of an IRA. Both advantages actually stem from one simple fact, and that is that you and your IRA are separate entities. The two important advantages when investing inside of an IRA are earnings in an IRA are income tax deferred, or could even be income tax free in the case of a Roth IRA. And the other advantage that we'll talk about in this video is the asset protection that you will enjoy with your IRA. All right, let's talk about the tax deferment and tax-free status first. Here you are. What do we know about you? Well, we know you have a name and you have a tax ID number. So do I. We all do. Now, our tax ID number, of course, is our Social Security number. We know that you can make investments, and we know that you are a taxable entity. So if those investments earn a profit, that profit is subject to income tax. Let's talk about an IRA. Now, we know your IRA, it has a name and a tax ID. It's a different name than yours. It's a different tax ID because the tax ID in an IRA is an EIN number, completely different from your Social Security number. We know your IRA may make investments, and we know your IRA is not a taxable entity on the profits earned inside the IRA based on the money that you have put in that IRA. So, if you invest, you're a taxable entity. When your IRA invests, your IRA is not a taxable entity on the earnings. And so on every investment you make, you have a choice of how you want the earnings to be taxed. If you own the asset, the earnings will be taxable to you. If your IRA owns the asset, the earnings are either tax deferred or, again, in a Roth IRA, income tax free. And it's up to you where you want to put the investment. Now, there's nothing wrong with investing personally. We all do it. But when we invest personally, of course, we're taxable entities, and so it's a bit like running in place. Yeah, we go forward because of the profit, but then we step back because of the taxation. Forward because of the next profit, back because of the taxation. You will, in most cases, hire accounting and CPAs to help you reduce those taxes, control those taxes, but at some point we're either paying taxes or paying the CPA, which we need to do, and I strongly suggest that we all do that. Investing for ourselves is a taxable entity. However, our IRA is not a taxable entity, and so every profit just keeps going forward. There's no step back because of taxation. And as I said, we have a choice on every investment we make. Do we want to make that investment, or should our IRA make the investment? Here we are. We found an investment. In this case, it's a house. We could buy it, or our IRA could buy it. We've decided in this case our IRA is going to buy it. So we can defer the taxes, or as I said, if it's a Roth IRA, eliminate the taxes. Now, this is a good point to bring up the asset protection that we get in an IRA. Now, many of us have read books on asset protection and read articles on asset protection, and after a while you begin to understand that the core of asset protection is that it revolves around separating you from the asset or the situation that might cause risk. That separation is what creates the protection. So here's you Here's your IRA. In our sample, the IRA owns the property. Oh, we have the dreaded slip and fall. Somebody slips and falls on the property. There's a risk. Now, before we get too deep into this, I do want to just pause and talk about the practicality of the situation for a moment. You have to look at the investment that you're making. Because if the investment you're making is something that's going to have a high level of risk, this becomes very important. If it has a lower level of risk, maybe it's not as critical. So if you're buying with your IRA a children's water park, a shopping mall, yeah, you're going to see these possibilities, slips and falls, etc. If your IRA is going to be buying residential property, you certainly don't see that very often. So you want to take into account, the type of asset, the risk of that asset. But in this case, we're going to go to the kind of a worst case scenario. We bought a residential house. The person slipped and fell. Again, very, very unusual that it happens again on a residential house, but we're going to kind of make things worse here. And so the question becomes, what risk do you face because of this injury this person has sustained? Remember, you're the individual. And the answer is, of course, you don't. Why? Because you are not the owner of the property. You and your IRA are separate entities, right? You have different names. You have different tax ID numbers. You're separate entities. What happens in the IRA stays in the IRA. What happens to you stays with you. The IRA owned the house. The IRA is separate from you. In other words, there's a wall between you and the assets in the IRA. So we've talked about two important things. We talked about earnings are income tax deferred or even income tax free, pardon me, and asset protection due to the separation of you and your IRA. If you want more information about a self-directed IRA or how to start one for yourself, there's our name, there's our phone number, 312-795-0988. Give us a call. Be happy to talk with you about this. Thank you for your time.